Hey, it's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of May 24th. How was your weekend? Hopefully it was great. God, it was great spring, cool weather, a little bit of warmth. Love this time of year in Northern California. I had a pretty good weekend. I rode my bike, worked on my boat, put some insulation in my garage so that it's a little cooler in the summer. Did a barbecue on Sunday, dug a ditch for a sprinkler line, had a dinner with friends on Saturday night. It felt like a weekend, ready for Monday. All right, so what's happening in the market? What happened last week? Last week was pretty flat. Rates ended the same way they started. We had some volatility in the middle, but nothing really happened with the rates overall. This week, let's talk about the three things that are going to affect rates this week. Inflation is number one, talking Fed points number two, and child tax credit number three. So inflation, I sound like a broken record. I've been talking about it for months. Inflation is on the rise. We've seen it on the rise. We know inflation is the death of rates in a sense. If you think about it this way, if you're investing in the bond market and you have $1 million in bonds with a guaranteed 4% rate of return, and inflation is 1%, your real net here is 3%, right? 4 minus the 1 in inflation, net 3. Well, now if you have that $1 million in bonds and your guaranteed rate of return is 4%, but inflation is now 3, you're only getting 1 back, 1% rate of return back. So what happens when the inflation goes up? The yield goes up, which is really rates. And so that 4 may go to a 6 or a 7 to keep that 3% rate of return. And that's why we see rates go up when inflation goes up. So the Fed last week announced that we are nowhere near the maximum levels of inflation that they're comfortable with. We're approaching 3%. There's a big report on Friday called the PCE. It's personal consumption expenditures. Basically, it's how much money households spend on stuff. And if we see that spending increase, we could see, obviously, it's a sign that inflation is going up. And this is going to measure a year over year inflation. So we expect this to approach 3%. And if that's up, we could see a big dump in bonds, meaning money's moving out of the bond market and mortgage rates go up. So Friday is a real pivotal day. We're not going to float into Friday. We really don't expect that PCE to be low. We expect it to be high, and we expect those rates to go up right before everybody takes off for the weekend. So the second thing, Fed talking points. A lot of Fed Reserve members are going to be just talking this week prior to next week, which is a blackout week. And so anytime there's a Fed meeting the week before there's a blackout, the Fed members can't talk about policy. And so really this is their last week to get on the microphone. So what are they going to say about one thing that we're watching? Tapering. And so tapering really is when the Fed buys less mortgage-backed securities. We all know that mortgage-backed securities, the trading of mortgage-backed securities is where mortgage rates are determined. The more money flowing into the bond market in trading mortgage-backed securities, we see rates go down. When money flows out of that bond market and we see mortgage-backed securities traded less, rates go up, mortgage rates go up. So the Fed, since COVID started, has been buying millions, billions of dollars in mortgage-backed securities every single week. They pump a ton of money into the bond market buying mortgage-backed securities, and our rates are artificially low because of that. And they have said, no matter what happens with inflation, the economy, they're going to continue to buy mortgage-backed securities. So the Fed is indirectly affecting mortgage rates. Well, they can't keep doing this forever. And we've all been waiting for the other shoe to drop. And when they really start to promote or give us an idea of when they're going to start tapering, meaning they're going to buy less mortgage-backed securities, they're tapering off buying those. And will that cause those rates to go up? Will the normal investment, the natural market actually buy those mortgage-backed securities the Fed isn't buying and keep those rates down? Everybody really expects that when the taper does happen, and they're starting to talk about it, they broached this subject last week, all these Fed members, that we're going to see rates go up. And some speculation that this could happen towards the end of the year, first part of 2022. So again, we'll see if maybe some more discussion happens about this. Tapering. The other thing that's happening with the Fed is we're in a short week in the bond market. So because of Memorial Day, the bond market closes at noon Eastern time on Friday. So there's going to be a lot of normal activity, and then basically the bond traders check out on Friday. Once this PCE report comes in, we'll see if that affects the market. But Friday at noon, it's over, and then Monday is a close day on the bond market, so there won't be any report out on Monday. I'll give my report on Tuesday. So it's a short week. It's a short week for the bond market this week and next week. All right, the third thing, child tax credit. You guys heard about this? Last week, a child tax credit was passed. Basically, what this means is that each family with a kid, individuals and couples, will receive $300 per child. This starts July 15th. Every month, $300 per kid going until December. And then there's a pause until April of next year, a year from now. And then what that means is these families are going to get this money per kid until December. Nothing's going to go into their pocket until tax time of next year, until April. And then they're going to get basically an accumulated amount of money that's been accumulating since January. So this is going to be, for some families, a lot of money in their pocket. And the income thresholds are actually fairly high. So will this stimulate? How will the family spend this money? If we look at recent past with all the stimulus money that's been going out since COVID started, yeah, a chunk of it's put into the economy, but a big chunk of it has been saved and invested. So this is a lot of money. Collectively, or in total, a family starting in July until April of next year could get about $7,000. That's a lot of money. Again, we'll watch how will this be invested. Will this affect the rates this week? Probably not, but it's something to definitely watch for. So what are we looking at this week? There's a lot of reports coming out, housing reports, nothing really that's going to move the market until Friday. That PCE report is really a big one. So we expect a flat market. We're carefully floating. We're in a very, very narrow trading channel. Really don't expect much upside or downside, but floating into Fridays is the best thing. If we see any movement, we'll lock. Not going to take any chances on that PCE report Friday. If we're going to lock, it's going to be Thursday, and then we'll take our chances on Friday. Okay? If you have any questions, shoot me an email. If you find this report beneficial, leave me some comments down below. If you know somebody could benefit from them, forward it off to them. Have a great, great week, and we'll talk to you next week. And happy Memorial Day weekend. Bye-bye.